Hey everyone, welcome to Value Sense. If you've ever felt like investment advice is, I don't know, written in some secret code for billionaires,
Which, to be fair, it often is.
right? Well, you're in the right place because we're here to cut through all that noise and make it actually make sense. No boring monologues or Wall Street ease.
Exactly, we bring sharp, clear insights, the kind that hedge funds use, but without the pretentious jargon or 10-syllable words. Think of it as powerful analytics paired with simplicity.
Beautiful simplicity. I mean, honestly, doesn't everyone need that? Anyway, get comfy because today's episode is loaded with
Big market shifts and strategic moves.
lots to unpack. I'm Ruby.
And I'm Eric. Shall we get started?
All right, let's dive right in. Eric, UnitedHealth. Wow. Can we just talk about how they've managed to drop not one, but two bombshells practically in unison?
Indeed, suspending their 2025 outlook and announcing a new CEO within the same breath was, well, let's just say it sent shockwaves through the market.
Shockwaves? More like a full-blown earthquake. They're usually the boring and stable kind of stock, right? Investors must have been like, wait, what just happened?
Exactly, UnitedHealth has long been considered a cornerstone healthcare stock. So this kind of volatility, dropping 10% pre-market, is highly uncommon. It's got a lot of people re-evaluating their positions in the company and, frankly, in the healthcare sector more broadly.
Right, and it reminds me of the first big industry shakeup I ever covered. It was this tiny biotech firm years back.
Oh, here we go.
No, seriously. They swapped their CEO with basically zero warning and their stock just tanked overnight. And then, like a month later, everyone realized the new CEO actually had this amazing track record and the company made a huge comeback. Investors who stuck it out made a killing.
Well, leadership transitions are always tricky. But in UnitedHealth's case, the market had strong expectations for stability, so even a good replacement won't alleviate doubts immediately. We might see more turbulence in their stock price before it levels out.
Do you think healthcare as a whole is going to feel the ripple effects?
Possibly, yes. Major players like UnitedHealth act as bellwethers for the industry, so when one of them falters, or even just seems uncertain, it can create a broader sense of risk among investors. Not to mention, it can affect affiliated sectors, like pharmaceuticals and insurers, indirectly.
Yikes. Oh, and don't forget the pressure from competitors. They're definitely watching this shakeup closely, probably treating it as a golden opportunity to grab some market share.
No doubt. But it also presents questions about UnitedHealth's longer-term strategy. Investors will want to see whether their new CEO can successfully drive growth while navigating the current macroeconomic challenges. There's certainly a lot of uncertainty to grapple with in the near term.
It's a wild ride, huh? All right, your turn. Tell me this. Why does it feel like when stuff like this happens, every other stock in the healthcare sector gets dragged down along with it?
That's the contagion effect. Essentially, when an industry leader like UnitedHealth stumbles, it shakes investor confidence in the resilience of the sector as a whole. It's less about specifics and more about perception, although sometimes a competitor's setback does directly benefit others.
Perception is everything in this game, huh?
It really is. And these leadership overhauls, unless they're clearly and immediately framed as strategic moves, can often be interpreted as signs of trouble, creating unnecessary panic.
Yeah, sounds about right. Investors do love a good overreaction. Anyway, enough about old UnitedHealth. Let's talk Robinhood. All right, shifting gears from UnitedHealth to Robinhood, let's talk about this WonderFi acquisition. What's that all about? Like, why now?
It's a clear move to strengthen their presence in the crypto space. WonderFi has built a reputation for its user-friendly platform, aggregating decentralized finance tools into a single ecosystem. By acquiring them, Robinhood's diversifying away from its core meme stock user base.
Yeah, they're like rebranding themselves from that one app college kids used to trade Dogecoin to, I don't know, a fintech heavyweight maybe?
Exactly, they're clearly signaling to investors that they're looking to broaden their appeal. Crypto has been a challenging segment recently, lots of volatility and regulation, but there's still immense growth potential there.
Sure, but it's risky, right? I mean, crypto's like the wild west of finance. You think WonderFi's tech is worth that gamble?
Potentially. It depends on how Robinhood integrates it into their ecosystem. If they can leverage WonderFi's technology effectively, they might carve out a competitive edge in the rapidly evolving decentralized finance or DeFi space. But you're right, the risk of overreach is definitely there.
Makes me wonder, what's the end game here? Are they trying to be like the Amazon of financial services?
Perhaps. The financial sector is seeing a lot of consolidation right now, and Robinhood seems to be positioning itself as an all-encompassing platform for younger, tech-savvy investors.
Well, good luck to them. Anyway, speaking of big moves, Shopify is getting bumped up to the NASDAQ 100. That's massive, right?
It is. Being included in the NASDAQ 100 means every index fund tracking that benchmark's now required to buy Shopify shares. That alone could drive their stock price higher, at least in the short term.
And they're booting MongoDB to make room, right? Got a sting for MongoDB fans.
It does, but this isn't uncommon. These indices periodically rebalance to ensure they reflect the largest, most impactful companies in their sectors. Shopify joining the ranks reflects their growing influence, especially as e-commerce continues to evolve.
Yeah, and it doesn't hurt that it forces funds to buy your stock. Free boost! Like, where was Shopify 5 years ago?
They've come a long way. In fact, it reminds me of a tech acquisition I was following years back.
Story time with Eric.
Laughs, no, seriously. It was a major acquisition where a relatively small company acquired an innovative AI firm, and it completely reshaped their industry. The ripple effects dramatically increased their market share and revenue within just a few years.
So you think Shopify could do something similar by riding this wave of momentum?
Possibly. It really depends on how they capitalize on this new status. But one thing's for sure, this NASDAQ 100 inclusion puts a massive spotlight on them, especially as they go head-to-head with e-commerce giants like Amazon.
Yeah, Shopify versus Amazon, that's a showdown I'd pay to stream. Laughs. But hey, what about how this shift will... Speaking of major financial moves, Eric, let's pivot to Barclays. They're saying we're only getting one Fed rate cut this year, all the way in December. What gives?
Well, it's a shift in expectations, isn't it? Previously, Barclays anticipated that the first cut would happen as early as July with a follow-up later in the year. But now, given the stickiness of inflation and the surprisingly resilient economy, they've adjusted their outlook. December's their new target.
Right, but isn't this just another case of the market overanalyzing the Fed's every move? I mean, it feels like every time Powell sneezes, analysts rewrite all their forecasts.
True. But remember, the Fed plays a pivotal role in shaping market sentiment. A delayed rate cut signals that they're staying hawkish to combat inflation longer, and that's bound to influence decisions around growth stocks, bonds, you name it.
I get it, but it's exhausting. Throws hands up. Anyway, let's switch gears. How about Warren Buffett? The man's ditching banks faster than I ditch cardio classes.
Laughs indeed. His moves were dramatic. Completely exiting Citigroup and New Holdings, reducing stakes in Bank of America and Capital One. It's clear he's not bullish on traditional banking right now. And with rising interest rates and potential regulatory headwinds, it's easy to see why.
Plus, with his shift into energy and other sectors, is Buffett basically saying, banks are too much drama, I'm out?
Essentially, he's likely betting on industries that can weather economic turbulence better than banks. But let's be honest, when Buffett pulls out, it's a signal to everyone else to rethink their strategy too. Banks might face a rougher time attracting big institutional investments in the short term.
So between Barclays signalling no cuts until Christmas and Buffett dropping banks, are we staring down a big market shift here?
Quite possibly. These events mirror larger uncertainties in global markets. Rising rates and slowing growth create an environment where investors need to tread carefully. It's a reminder that diversification and adaptability are crucial strategies right now.
Basically, don't put all your eggs in a Bank of America basket, huh?
Laughs precisely. And stay informed because these economic shifts have ripple effects everywhere. From equity markets to emerging economies, things can change quickly as new data comes in.
Well, here's hoping our listeners are keeping their portfolios as versatile as their TV binge lists. Laughs.
Laughs, that's one way to put it. Seriously though, understanding how these shifts impact the bigger picture is key to navigating the uncertainty with confidence.
Couldn't agree more. And on that note, that's it for today, folks. Thanks for tuning in to Value Sense.
It's been a great chat as always. Take care and we'll catch you next time.